Right. Today's topic is capital asset pricing model. The most important, famous and important CAPM model, as you know, capital asset pricing model. So I'm going to, since we covered capital market theory, CMT last time, I'm going to compare this with the capital asset pricing model. First, when we discussed capital market theory last time, we talked about the portfolio of like T-bills, risk-free assets, and market portfolio. As you know, the market portfolio is the portfolio that includes all risky asset in the market. Right? That's the theoretical definition. So when you talk about the asset in capital market theory, we're talking about very well diversified portfolio, right? But CAPM is like generalized asset pricing model. So it's both, whether it is the portfolio or individual securities, whether it is diversified or not. So that's a more generalized asset pricing model. And then the risk factor, in capital market theory, we are talking about the total risk measured in the standard deviation, right? Standard deviation, that's the risk measure. But CAPM, the risk measure, include only systematic risk portion, right? So unsystematic risk portion is not included here. Systematic risk portion, that is the total risk, the portion of the risk that is correlated with the market movement. So instead of the standard deviation, we include the standard deviation and the correlation coefficients there. So the portion of risk that is correlated with the market, that is the systematic risk, right? So, in capital market theory, we use the sigma, that's the standard deviation, but this CAPM model, sigma times correlation coefficient between the stock and the market, all right? Because it is the systematic risk. Okay. In capital market theory, the graphical illustration of capital market theory is called capital market line, CML, right? Remember that? The equation is this way. Now, to derive the security market line, which is the graphical illustration of this CAPM model, to drive this one, instead of using this standard deviation, we put the standard deviation times correlation coefficient, right? Sigma times RIM, and that's it, right? So it's just replace sigma total risk with the systematic risk, which is sigma times RIM. That's right. That's it. And this one, the expected return for the market and minus risk-free rate, that is the market risk premium, that is there. But the rest portion, sigma times RIM, which is this one should be subscript. So the correlation between the stock and market portfolio and divided by market standard deviation, this one is called beta. Beta, that famous beta that you know, that you heard. So if you replace the whole thing, this whole thing with beta, this is CAPM model, Right? This is CAPM model. But as you see, so everything is in expected model, right? Expected model. That means we are talking about the expected return next period, right? So we have this. Now here, if you compare the graphic between these two, the capital market line, the intercept is risk-free rate of return, right? And then the x-axis is, the risk measure, total risk is a standard deviation, and expected return. That is the capital market theory. Intercept is risk-free rate of return, and then the market portfolio is M, meaning sigma M and expected return M. If you connect these two, this straight line is called capital market line, right? Capital market line. Now, if you look at the right-hand side, the risk measure for this one is on axis, which is beta there. Beta is the risk measure, and then the y-axis is expected return, right? And the market portfolio, beta of market portfolio is always 1. That's the benchmark, right? And then the expected return, if you put this one, that M is the market portfolio. So if you connect risk-free rate of return intercept and this market portfolio straight line, it is called security market line, right? Security market line, right? Just 1 second. That was my puppy. Okay. So this is the comparison between capital market theory and capital market theory. That should be capital market theory. Capital market theory and the capital asset pricing model. And again, the relevant asset for capital market theory is well-diversified portfolio, but CAPM deal with either portfolio or individual securities, diversified or not. The risk measure for capital market theory is total risk, which is measured by standard deviation, but CAPM only, systematic risk. So which is the portion of total risk correlated with the market only, right? Okay. And then asset line equation is like this, and derived from the capital market line, we have security market line here, and then graphical illustration is this way. Let's apply this one to the real situation there. Okay. Let's talk about this capital asset pricing model, right? Capital asset pricing model, as you see here, this one and beta, right? It shows the relation between expected return and beta there. In this form, it shows like if you subtract risk-free rate of return, it is called risk premium, right? So the third portion is the market. This is the market risk there, right? Should be market, right? So this is the market risk premium, which is in here, located in here. And if you multiply that by beta I, that's the security I's, the risk premium, which is the right-hand side. Right-hand side, the stock I's risk premium is a function of market premium and beta, systematic risk, right? Beta. So beta is this, sigma I, the total risk times correlation coefficient there, correlation divided by market standard deviation, and this one, the RM minus RF, that's market risk premium, and RI minus RF, that's the security stock price risk premium. All right, so the key point is the risk premium of a security, of a stock, this one is directly proportional to both systematic risk here, systematic risk. This portion is proportional to systematic risk and market risk premium. Market risk premium is a function of beta or market risk premium and market risk premium. Okay. If we put this the CAPM, capital asset pricing model, on graph, it is called security market line. Security market line that shows the relationship between risk, required return and beta, required return over risk asset is equal to, this one in the risk premium form, the stock ICE risk premium is a function of beta and the market premium. But if you move this one to the right-hand side, is this required rate of return of a risky asset stock is, if you move this one to the right, risk-free rate of return plus this asset's risk premium, which is beta times market risk premium. That's what it is. Okay, so if I okay, so if I rewrite this, yeah. Yeah, risk-free rate of return plus this. See? Oops. Okay. Oh. Right. Subscript there. Okay. This is the more like popular, more widely known form here, right? This one. So let me put this one also. Okay, let me give you the complete form. Expected return. Right. This is the complete form. This is complete form there. Okay. That's it. So that's more widely known form of the capital market, capital asset pricing model. So because capital asset pricing model, the target or the goal of using this one is to calculate, to determine required rate of return of a stock, of a risky asset. Right? You see that? So the required rate of return, CAPM return of a stock is the sum of risk-free rate of return plus beta times this is the market premium. So this equation, this CAPM equation, are used to determine or calculate a stock's required rate of return. Right? All right, let's use that here. Okay. So probably we will change this one to same form. Okay. Same form. Plus. Right. The form that I just gave you, right? So let's use that one. That's more relevant here. Okay. Suppose let's do the actual calculation there. Given the risk rate of return is 5% and the market return is 9%, meaning this like T-bills, 5%, which is very high compared to the recent one. Now the market return is 9%. That's reasonable. And then we have these 5 stocks, right? 5 stocks, A, B, C, D. Now beta for the A is 0.70. Beta for stock B is 1, and C is 1.15, D 1.4, E is minus 0.3, minus 0.3. See that? Let me give you a couple of important idea. Beta is equal to 1. The beta of the market portfolio is 1. Okay, is the benchmark. I mean, starting point. So stock B, it is either a market portfolio, or a stock is a very mature stock that behave exactly like the market portfolio. Like, I think as a stock or as a company becomes large and mature, the behavior of this stock is very much like the market portfolio, or is becoming like the market portfolio. That's a wide known like idea. So the stock B is either it is the market portfolio or a very mature, large blue chip company that behave very much like the market portfolio. You see what I mean? And E has negative the beta. Yeah, negative beta. That means the behavior, the moving direction of this stock is the opposite, tend to be opposite to the market portfolio movement, right? So if it is we use S&P 500 as the market portfolio proxy, right? So if we use that stock S&P 500, probably the bond portfolio, the government bond or the corporate bonds, they move similar to this, the negative beta. Stock A, if beta is less than 1, then we say, the stock A is less volatile than the market if it is less than 1, right? If it is higher than 1 here, like C and D, we say the stock C and D are more volatile than the market. Is that right? Okay. Did you get it? That's the picture, big picture of different beta, the size of beta, all right? So we have this one negative beta, which shows negative reaction or movement. The opposite movement to the market, the direction movement, and one is like volatile. The less volatile, that's very stable stock, like utilities, right? And then the C and D is more volatile than the market, right? Like the information or technology stocks. All right, we have this 5 stocks. Now, given this CAPM model, and then given the beta, then I told you this CAPM model is used to determine required rate of return of a risk asset. CAPM rate of return. So this CAPM rate of return, required rate of return by CAPM, is a theoretical benchmark in your investment decision making. You'll see that later. So let's use this CAPM model to calculate each stock's required rate of return. I'm going to use this CAPM model exactly, right? So let's see. Stock A. Required the risk-free rate of return is 5%, right? 5%, 5% plus beta is 0.7 times the market return is 9%, 9% minus 5% is 5%, yeah, 5%, okay? That is the CAPM model, right? CAPM model. So what do we have here? 7.8%, 7.8%, okay? And then if beta is 1, what's your guess of the return of the stock B? Stock B's beta is 1, and what is the expected return for stock B is exactly the market return, right? So let's do the same thing. Okay, let's do the same thing here. So 5% plus beta is beta. Oops, what is that? Yeah, 5% times beta times the market portfolio times market return 9% minus 5%. Here, see 9%. 9%. I told you this stock B is either the market portfolio or the big mature blue chip stock that behaves exactly like the market portfolio. All right, now we did apply that one. Let's now copy and paste, right? Copy and paste. So these are all, right? These are all, me put it, okay? Okay. These are all CAPM return, CAPM return, all right? Okay. Now, if you put this together, beta and expected return, that will give you what security market line, right? Security market line, which is exactly here. Do you see that? The blue line, blue straight line, that is the security market line, okay? I put it in here graphically, all right. Folder here, there, okay. Now, so do you see this one here? This is security market line. Every point that represent the combination of systematic risk and is expected return, CAPM return, right? So like, beta, the first stock A, it has the beta of 0.7, and the return is 7.8% there, right? And the stock B, beta is 1 and your 9% return. And then which one is, the stock E, -3, that's the beta, -3 and 3.8%. And then, P is 1.4, that's, where is it? 1.4, yeah. 1.4 here, right? 1.4, and return is 10.6%. So all this one is theoretical benchmark, theoretical CAPM return, which is determined this capital asset pricing model, and that will be, theoretical benchmark return on your investment. Yeah. Now we finished the theoretical part. Okay. Let's get into the actual part. So analysts, Wall Street analysts, they look at all these stocks and they use this information like current price, expected price, and expected dividend. They use this information and determine the analyst estimated return. Estimated return. Given this information as in the textbook, do you remember that the return, estimated return, is the stock return include two different portions. One is the capital appreciation, the price difference, right? Price appreciation return and dividend yield, right? For example, here, the income here, stock A, let's look at the income. Two income is, one is what? One is the price change there. Price change is 26 minus expected price, 26 minus 25, that's $1. And that's a price appreciation. And dividend yield, dividend is $1, right? Dividend is $1. So we have two different sources of income. Two sources of income. One is price difference, the other one is dividend. So what you do is, to calculate the estimated return is, you sum them up and divide that by your initial price. So this is what you do. 26 minus 25. This is price return, right? Price return plus dividend is 1. That is the cash flow that you expect. But we need to calculate. The estimated return. So divide it by the initial price. So what do you get? This is 8%. 8%. The same way for D. Let's do this. D. Here, 66 minus 64. That's a price appreciation. 2 plus dividend is 1. Right? Divided by initial price. That is your return there. Okay. All right. Let's copy. Let's copy this. Nope. Actually, let's generalize this one here. Let me do it again. What you do is 26 minus 25 plus dividend here, and then you have to divide that by initial price. That's your expected return. So copy and paste. Second, copy and paste. And then the last one is the same way. This minus this plus 0. Okay. All right. Divided by initial price here. Okay, we got this. This. Let's change that to percentage and okay. All right, now I told you this CAPM return is used as benchmark, right? As benchmark. And then this one is analyst is the estimated return there. Okay, one thing is, let me put this one on the whole thing. I'm gonna copy and paste special, no, paste value. All right, now percentage and yeah, okay. So you have this one here, right? Now, this one is theoretical benchmark, and we got this one. Now, based on this this CAPM return and estimated return, analyst estimated return, we can make our investment decision-making conclusion and decision-making there. Now, one thing is that identify, based on this information, we can identify the undervalued stocks or overvalued stock, right? In equilibrium, all asset and portfolio should be located on this CAPM line, right? CAPM line. When the market is in equilibrium and the asset price, the stock price is valued rightly in an equilibrium condition, then all the estimated return should be on here. But any security that floats above the SML, if the stock is located above this SML, what does that mean? next year's return, estimated return, is better than CAPM return, better than CAPM return. So is it good or bad for you? It's good for you. It's good stuff. Good stuff. It is called underpriced. Underpriced is the good the target for investment, right? Target. If it is located below CAPM, the SML, SML, it is like not a good stock, not a good investment because it is overpriced. It is overpriced. Okay. Any stock that is on here, it is not overpriced, it's not underpriced. It is, you could say, rightly priced or fairly priced. Okay, fairly valued. All right. So you see what I mean? Here, analysts they calculate, they estimate the estimated rate of return, and then they compare that to the CAPM return, and they get the feel whether that stock is overvalued or undervalued, or whether that the stock is bad investment or good investment. All right. So now, if I put this estimated return on here, now stock, which one is that? Stock A, that's 8%, stock A, or 0.0. Stock A is like very close or same, right? Stock A very close. So we could say this is fairly valued. Stock B is 6.25%, right? 6.25%. The beta is this one here. No. Stock B is 9%. Now, stock B is 9%. That's CAPM return, but estimated return is 6.25% here. So this one is overvalued. The second one is overvalued, right? So this is rightly valued. This one is right. This one is the overvalued because estimated return is lower than that. Now, stock C 1.15, it is located in here. So what do you say? Is very, is highly underpriced. So this is a good investment. It's a good investment. And stock D is, look at this. This is CAPM return. This is estimated return. So it is located here. So it is like a bad investment because it is overvalued. And stock E is, it is above the capital market line, security market line. So it is underpriced. It's a good investment, right? That's how you use CAPM model and calculation, and then security market line, and the estimated rate of return, and compare those two and make your conclusion whether it is underpriced or overvalued, or whether it is a good investment or bad investment. Now, a superior investor must derive value estimate for assets that are consistently superior to the consensus market evaluation to earn better risk-adjusted rate of return, of course. If you have the better, the better evaluation or valuation process or model, and you can probably record consistently superior return to the market or to other peer analysts, right? Peer investors. Okay. Beta calculation. Let me give you some more details on beta. Okay. Beta, I told you the mathematical formula for beta is the standard deviation of stock I divided by the market standard deviation times the correlation between the stock, and the market, right? So covariance. I mean, the covariance is right, covariance is the sigma. All right, sigma I. Let me see. How do I borrow this? Yeah. This sigma I. I mean, covariance is this one times this one times R I M I R R I M. Okay. So the covariance is this one. Okay, covariance is, and if you put this one, oh, this one is M. Okay, so it's M. So the sigma I, sigma M, sigma, and the RIM is covariance. If you put this one in here, you get the same equation, right? So one way is to use this mathematical formula, right? Mathematical formula. I'll show you the other way, the more like, complicated way. I mean, a graphical way or statistical way. So mean, let's calculate the mean of this S&P 500. S&P 500, we are using mean average. The S&P 500 is used as a proxy for the market portfolio, right? That's the monthly return average is the 0.99%, and if you get MXXO average of MXXO is 0.70, and 1.35 is the Microsoft monthly average return. Standard deviation is STDV, okay? And there, that's a 2.97% is the standard deviation of S&P 500. And let's copy and paste, right? Okay. So standard deviation of the MXXO is 3.18%. Microsoft 6.06%. Yeah. Okay, correlation coefficient. As I said, the S&P 500, that is M market portfolio. So let's calculate IM, correlation coefficient. Correlation coefficient with this stuff and market portfolio. IM, correlation coefficient is 0.95. That means 0.95 is very high number because the correlation coefficient is between -1 to 1. This one, 0.95%, is very close to 1. So very strong positive correlation, meaning MXXO are moving very similarly. I mean, very close to the market portfolio. Let's see the Microsoft correlation coefficient. Microsoft and S&P 500 market portfolio. We have 0.4944. Interesting. Probably this data, this is data from the textbook, right? This data comes from like all the years. I mean, that's many years ago, several years ago. Because Microsoft's the behavior pattern is very similar to S&P 500 these days, right? Similar to. All right, so we calculated correlation coefficient for both stocks. Now, how do you calculate beta? You use the formula there, right? Standard deviation, here standard deviation market, and then correlation coefficient. So standard deviation of this stock divided by, and the market portfolio times correlation coefficient. This one, see, 1.02, that's the beta for MXWO. Okay? And then this one is here, standard deviation of Microsoft divided by standard deviation of S&P 500 multiplied by correlation coefficient. We have 1.00, 1.01. You see that? That's the beta is very close to the market portfolio. So this one. See? All right. Okay. Now, so we successfully calculated beta for MXX. So these two stocks. So this is the beta. Right?
Could you show those formulas again?
Which one?
Oh, yeah, that one. Yeah, that one.
Yeah. The formula is, you know, I follow the below formula below that. That's stock's standard deviation divided by the market standard deviation multiplied by the correlation coefficient. Okay, and this one goes to that. All right. Okay, that one is how to calculate beta using the mathematically. And another way is to get the regression analysis. Anybody did the regression analysis? Okay. You regress individual stock return on the market return, right? Right. This is how to. Okay. Regression analysis. First, go to data, and data analysis. You have to have this one here. If you don't have data analysis, you probably, I mean, let's start from the beginning. Go to File, and then go to Options. Wait. Nope. Add in, yeah, Options. Add in, and then here, Analysis Toolpath. You see that? You have to click on Analysis Toolpath, and then press OK. All right. Then you will have this data analysis on here, right? So if you don't see data analysis on your Excel, then you have to do that. File, Options, and then add in, and then click on Data Analysis Toolpath and say OK. Right, and say OK, then you will have this menu on there. Now, click Data Analysis, and you have a lot of, many functions there. Now, click on Regression Analysis, and then you have this menu box, right? Menu box. Okay. Y range, Y variable is your stock. So you highlight this, your stock. X range is the market portfolio. So market portfolio is here. And then an output range, probably I like to see that on this screen. So probably J2, J3. J2 or H3, the cell, and then click OK. Then you will get this regression analysis, right? Assuming linear regression, I mean a linear relationship between the market and your stock, right? Your stock, and here, this linear regression equation is this. I mean, X is I mean, now y is, I mean, if you use like easy form, b x there, right? Right. So this y. So that is your regression line. I mean, a regression analysis to estimate the linear regression between x and y, So y is your stop, and x is the market portfolio. So statistically, in statistical term, you do regression. You regress your stock MXXO on the market. Regress yours on the market, right? And then this result gives you all this like, R squares and the F statistics, and then the correlation coefficient, I mean, estimated coefficients there. Now, intercept is this one, and X coefficient is this one. So there it is. Y is equal to minus 0.30272 plus 1.02 times X. That is your estimated coefficient. That is estimated coefficient. I put this together in here, right? In here. And the estimated slope here on this regression analysis, this one, 1.02, that is the beta of your stock, which is 1.02, right? 1.02, 1.02. This is the second way to estimate beta, right? And let's do the regression, same thing for Microsoft. So again, go to data analysis and then regression, okay. And then input level, this time is the Microsoft. Let's put Microsoft. And then this X variable, same way, the S&P 500. And then click on, okay. And H3, let me, put it on the same place. Yes. You see that? We have another regression result. Okay, this one, you regressed Microsoft return on the market return. And the result is here, Y Microsoft return is A is here 0.349113 plus 1.01 times X. X is the Microsoft return. All right. So estimated slope 1.01 is the beta. Okay. That is the second approach to estimate beta. Now, if you look at the your textbook, the calculation on this one, I think there was some mistake there, right? So we did all this one mathematically exactly same way and everything. You'll find some slightly different answer there. Just ignore that because they are wrong. Right? They made a mistake on there. This is correct number, right? They show slightly different numbers. One thing that I found was that in the textbook, they used different measure. I mean, when you calculate standard deviation here, 2.93, 3.18, 6.106, this one is like our sample standard deviation, given our sample here, right? Given our sample standard deviation, but they computed population standard deviation, which is slightly different formula, right? Slightly different formula, but for given this like sample data, this is the right way and this is the right number. stick to this way, all right? We got this beta here. This is how to calculate. And beta, the stability of beta. I mean, there is a lot of discussion on beta. So first, betas for individual stocks are not stable from time to time, or depending on the market portfolio, the proxy on the market portfolio. We use the S&P 500. That's the most popular way, most widely used proxy for market portfolio. I use in all my research, the S&P 500 is my market portfolio. And sometimes they might use like Dow Jones Industry Average, or they might use New York Stock Exchange like composite index. So it's all the different person may use different market portfolio, different proxy for market portfolio. Then the beta will be different, right? Beta for individual stocks are not stable. Portfolio betas are reasonably stable. If you calculate, if you estimate beta for the well-diversified, diversified portfolio, that is relatively stable, right? Individual beta, individual stock beta, usually not very stable. And the larger the portfolio and the longer the period, the more stable the beta of the portfolio. High beta tend to decline over time toward 1, where low beta tend to increase toward 1. I briefly mentioned this one, right? As a stock becomes large and more mature over time, this stock, this mature, large blue chips, they tend to be moving similar to the market portfolio, meaning the beta of that portfolio is getting closer to 1. So if the beta is above 1, and over time it tend to approach the 1, and if it is lower than 1, then it tend to move toward 1 to the market portfolio. Trading volumes may affect the beta stability, and positive relationship between beta and rate of return on risky asset, of course. So mostly the beta is positive, but if a asset is moving in the opposite direction to the market, that will have the negative number, negative value, right? Okay. Multi-factor model. Let's talk about multi-factor model. And one of the the early finding is called arbitrage pricing model. Arbitrage pricing model. It is the generalized multi-factor model. And the advantage of this one is that there is no need for unrealistic assumptions or the market portfolio. So, arbitrage pricing model does not need the market portfolio. But in CAPM model, we need market portfolio, right, to estimate the beta, right, systematic risk. But this one does not. So general model is this way. It's similar to the CAPM model. If you look at this one here, risk-free rate of return is similar to zero beta, the return there. Lambda 0 is comparable to risk-free rate of return. Now, beta is comparable to this B, right? B1, and this is market, the premium, right? This is one of the market premium, and this one is like first premium, risk premium related to J's common risk factor. So we have one to, onto the multiple. B is what? B is the responsiveness of the asset. The lambda is risk premium related to this risk factor, right? So beta is comparable, B is comparable to beta, but we have multiple, right? Lambda is comparable to the risk premium, this market premium, risk premium to this risk premium, the first risk premium and second risk premium, and this way. All right. So sum of risk premium times B responsiveness, sum of that plus 0 expected return on the 0 systematic risk. That is the expected return on APT, arbitrage pricing model. So if you compare CAPM and APT linear, the same thing. Risk factor, we have only one here, right? Market portfolio, systematic risk. And then this one is multi-factor, multi-risk factor. And then factor risk premium, we have this one market risk premium, and we have this lambda, right? Factor risk sensitivity, right? Risk measure. One is CAPM, we have beta, but this one is B, J. And then 0 beta return is a risk-free rate of return. This one is 0 beta return on APT. All right, let's see some simple example. This is not widely used model, okay? Because it's lacking in some like realistic application. So, for example, let's assume we have two factors. Factor one is unexpected change in inflation factor. Second one is GDP factor, unexpected change in GDP factors. We have two risk factors there. Now, risk premium for factor one here is 0.02. That means this risk premium is 2% for the 1% change in the inflation, unexpected change in inflation. So 2% premium for 1%, the unexpected change in inflation. Second, risk factor premium for factor two, GDP factor, 3% risk premium for the unexpected change in risk premium, or 1% change in GDP unexpected growth. All right, so we have these two risk premium, and this is a return on 0 systematic risk. I told you this one is similar or comparable to risk-free rate of return, 4%. So if you put this one together in the APT model, is 0.04 plus 0.02 B1, 0.0 plus 0.03 B2. That is the APT model. Okay, it's easy, straightforward, right? Now, given stock X's response to this factor 1 and 2 is 0.50, 1.50. Stock Y is 2.0, 1.75. Assuming, given this, then what is the expected return for X? Just use this number, right? This model. So let me do this. 0.04 plus 0.02 times 0.50, right? Plus 0.03 times 1.50. I just entered this B1, B2 in the APT model. Simple, just straightforward, nothing complicated. So what do you have? Well, we have 9.5%. 9.5%. Okay. Now S set Y, same way. 0.04 plus 0.02 times 2.00, 2.00, wait, is the percent, right? Wait. Yeah, okay, right. Responsiveness is just responsiveness. 0.04 plus 0.02 times 2 plus 0.03 times 1.75. 75 is 13 point percentage, right? Look at this. So using arbitrage pricing theory, the expected return for stock X is 9.5%, and expected return for stock Y is 13.25%, right? This is how we calculate expected return, just like we did a similar, similar to what we did in cap and return, right? Cap and return. Now, once we calculate APT return, we can use this. Given the current price of X and Y is $35, $31, expected price in 1 year will be, simple, 1 plus 9.5%, 9.5%, right? 9.5%, that's it. So what do you do? Yes. Oops. Okay. Typo, what? 1 plus 9.5%. Yeah, okay, yeah. And this one, why? So, if the expected return is 9.5%, so you just 35 is current price, and then multiply that 1 plus 9.5%, that will give you $38.325. It is the next in 1 year price, $38, 38.325. And then the next one is Y is, this one should be 31 because it is $31. 1 plus 13.25%, 25%, right? Get this one here. Right, see that? If you calculate this, oops, all right, okay. Now, if you use this one, expected return, then current price, then the Y, stock Y, the 1 year, the price, expected price in 1 year is $35.11. So this way you could get expected price next year, right? Okay, now that one was see, this is multi-factor model, right? One type of multi-factor model, another type of multi-factor model is what? Macroeconomic variable-based risk factor model. Macroeconomic-based risk factor model. So, for example, Chen, Rao, and Ross provided this model. See that? All this variable is what? The first one is market portfolio, New York Stock Exchange listed stuff. I told you. Some they use the New York Stock Exchange like composite index as the market portfolio. Second is the monthly growth rate in U.S. industrial production. That's macroeconomic variable. And then change in inflation, macroeconomic variable. And actual, all right, difference between actual and just the inflation variable, inflation cost, the bond credit spread, the macro like in a bond market, and unanticipated term structure shift. So all this one is like macroeconomic factors, variables, right? Variables or related, variables. That's why you call macroeconomic based risk factor model. Another category is microeconomic based risk factor model. So it's not macro level economic variables, it's the micro or stock or the portfolio level risk factors. Yeah. Now the multi-factor model is Pharma and French. Pharma and French, they provided this way. Okay. The risk premium for stock one is a function of here. This is the market risk premium, right? Market risk premium. And SML and HML. SML is small minus big. This one is size related stock, size variable, size, the small minus big, right? Small minus. We're talking about the size of the stock in terms of market value. So it's a return to a portfolio of small cap stocks minus the return of large cap stocks. Return with that one is. Do you remember size factor? Size factor in the chapter 5, right? Right. Okay. In the efficient market hypothesis, size variable was identified as a potential risk factor. Do you remember that? Right? In chapter 5. And also, there's another risk factor there. There was book to market ratio, market to book or book to market ratio. Right? So that one, HML, that's book to market, right? So HML is the return to a portfolio of stock with high book to market value, and that one is usually that one is called value stock, right? Value stock has high book to market ratio, less minus the return to a portfolio of low book to market value. Usually low book to market value called growth stock, right? Growth stock. So this one is size factor, size related risk factor. This one is book to market value, or is called like the value related risk factor, book to market ratio, right? So this B1 usually called B2. This one is like, CAPM model. Do you remember that? CAPM model, beta and RM minus, RF. So B2, so this is beta, comparable to beta in CAPM model. This one is called, let me write it here. The size premium, because this is a premium for size factor. Does that make sense? This one we're talking about value factor, right? Value factor. So we call, and B3 is called value premium. Usually, premium. Size premium, value premium. All right. So this one is a result from this Pharma French, paper in research in 1993. Get this. This model, if you look at this model, if you get rid of the second and third factor, that is what? Exactly this one is the equivalent to CAPM model. You see that? So this is single factor. So single index model. So, the low P ratio that shows 0.94, that is the beta. So low P ratio is lowest. That's beta, which is less than 1, meaning like less volatile than the market. Highest P ratio is 1.10, is beta. It's is more volatile than the market. All right? That is the single index model, which is CAPM model. Now, the next one is if you include the second and third risk factor, size factor, value factor. Okay. Right. They estimated B1 is 1.03, B2 is 0.24. I told you this 0.24 is a size premium, right? Size premium. So size premium, do you remember size factor there? Like small cap shows higher return, right? Small cap is riskier, so the return should be higher. So if you see like positive size premium, that means this portfolio tend to be small cap stocks. You understand? So estimate here, and the estimation result here is you get B2 positive B2 0.24. So size premium is positive. That means that happens in a small cap stock, meaning on average, lowest P ratio tend to be small stock, right? That's how you interpret this result. Now, if you look at value premium is positive and strong. Positive and strong, what that means is this lowest P ratio tend to be value stocks. That means low book to market value, that one tend to have positive, the value premium. Okay, so if it is positive, the premium, the value premium is positive, then that means this portfolio, this portfolio tend to be the value stock with high book market value. Okay. Now, highest one. I mean, if you look at the highest P ratio, you have negative value, but it's not significant, right? It is not significant. The negative value means this one is likely to be larger stock, large size stock, large cap stocks. And this one, negative value premium means the portfolio tend to be not value stock, but growth stock. Okay. So just remember, I mean, this one is this beta 1 is the same as beta that we learned in the CAPM model. B2 is called size premium. If it is positive, that's a small cap. And B3 is a value premium. If it is positive, this one tend to be value stock. All right, that's how you interpret. All right, it's a little bit complicated, but if you come up with this like Fin343 3-factor model, I mean, it is called 3-factor model, right? That's famous, very famous Fin343 3-factor model. Actually, year 2000, I was in the conference that the Fin343 they presented one of their very important like research result paper in New Orleans. I was there for their paper presentation, and I mean, Pharma, he is a very famous like finance faculty in University of Chicago, and French is in I think MIT or Dartmouth. They have been doing research together for quite a while, and then and made a significant, one of the most important, one of the largest, like the contribution in modern finance or investment like area. So Eugene Farmer, he got the Nobel Prize for his contribution. I think French also deserved that, but he has not got the Nobel Prize yet. So I noticed that Farmer French, they call each other a junior, right? So they're friends, but they call junior in their presentation there. That was funny. All right. Carhart, 1997, he just simply added one more variable, one more risk factor to the Farmer French three-factor model. It's called like momentum factor, and he suggested like important the result. So, and Farmer French also. Okay, wait a second. This one should be not that one here. So let me add one more. Okay. This one is RMW. And this one is CMA. All right. Okay. Oops. Okay. RMW, let's put it up there. And this one, also this one, put it up there. About 12 years later, 2015, this Farmer French, like three-factor model is widely used in the investment industry. Okay, the investment industry, the three-factor model. I'm talking about this. In the industry practice, they use this one. I mean, in fact, Farmer and French, they established like multi-billion-dollar investment company, and the Farmer was the founding like a CEO. French was the founding initial like managing director, president there. Yeah, president or managing director, either way. It is still like it's still going. So I'm not sure whether Farmer is still the CEO or not. I think he gave it to his son or some other people, professionals later on. But he still have the major stake on that company, multi-billion dollar value, the investment advising company. Okay, and they use this model. Their own model is the basis. In addition to this three-factor model, they have a lot of different models there. They use all of them in managing and running their multi-billion investment business there. 2015, he added two additional variables there, and this one actually, yeah, this one should be 5, and this one should come up there too. He used this model, their model in their the business, and then 2015 he added two more risk factor variables. Identified two more risk factor. One is return to a portfolio of high profitability stocks, less return the low profitability stocks. That's another additional risk factor that they identified. Another one is return to a portfolio of stocks or low investment firm, less the high rapid investment. So it's investment growth potential, investment growth potential. So that's the fifth risk factor that they identified, and they proposed this, 5-factor model, French 5-factor model. Of course, they use this one in their own like investment consulting, investment business there. And the potential candidate for risk factor include volatility, momentum, size, value. This one was already used, and then growth, it was used, size, non-linearity, liquidity, financial leverage. Those are like potential candidates for additional risk factor. But up to now, like 5-factor model is like most popular way, and some author, they proposed like 7 or 8 model too. Okay, so this is all about the this was all about the multi-factor model, right? You have any question? So I think you will come across with some APT model. Just follow this procedure, and then if you see any 3-factor model, just remember B1 is equivalent to beta that we estimated in CAPM. B2 is size premium. B3 is value premium. Size premium is positive for small cap stock, right? And value premium is positive for value stocks with high book market ratio. Just remember that. Have any question? All right, enjoy that. And then, oops, yeah, continue.